I was a full-time law professor. I was always telling my students, it's not what you know, but your ability to communicate it in an understandable manner. And the problem is, when you're doing estate planning or tax planning, we tend to explain stuff using terminology that is not part of the vernacular. Like if someone talks about a reverse Q-tip, or a grat, or a clat, or a grantor clat, or a non-grantor trust, those are terms of art that most individuals are not familiar with as part of their everyday conversation. And so when we're explaining estate planning techniques to potential clients, the difficulty is communicating highly technical stuff in an understandable manner. And describing it using like a Q-tip trust or a bypass trust or a marital trust or a generation skipping exposed trust or a GST exemption, some of that stuff can be very confusing. And I always tell my students that in teaching this stuff to my students, what's the difference in teaching it to law students and teaching first graders in elementary school? And the answer is none. You can't assume any prior knowledge. But when you start to really explain very technical estate planning techniques, it becomes confusing because you're using terminology and you're describing the financial consequences of these techniques. And I found that when you try to explain it just orally and just say, you know, assume this and basically assume that, you find that it's very difficult for the clients to understand it. So what I found is, rather than get into the technical details or describe it using the technical terms, I basically try to use simple to follow numerical examples. And this comes from teaching, because this is how I was able to communicate it to my students. And in estate planning, there's 4 factors that contribute to the shifting of wealth from the individual who would otherwise die with those assets and be subject to estate taxes to irrevocable trusts that are not exposed to estate tax. And there are 4 factors that are very important. One of them is something that the estate planners use all the time. I call it creating artificial valuation discounts out of thin air. But when you use that term, it says there's something wrong with it. But actually, there is nothing wrong with it. What you do is you have a closely held business. You own 100% of that closely held business. And essentially, the first thing you do is, that closely held business could be worth, say, $10 million. In other words, if you wanted to sell your closely held business, an investment advisor would tell you, you can sell it for $10 million. But if I wanted to do an estate plan and use $10 million, make a $10 million gift, I have a $5 million gift tax exemption, or a $15 million gift tax exemption, or whatever. So the first thing I do is I recapitalize the business into voting interest and non-voting interest. And because you don't have control, the non-voting interest can be discounted. In the real world, all publicly traded stock is discounted for lack of control, because if you become a shareholder in a publicly traded corporation, you don't have any voting power. So essentially, we're talking about valuation discounts. And also, if you have a closely held business, you can't sell it instantaneously. like you can a publicly traded stock. You call your broker up, you give them the sell order, and they sell it in 10 minutes. So essentially, if you have a closely held business, you can take valuation discounts for lack of control if you have a non-voting interest, and also lack of marketability. So essentially, if I want to make a gift of my closely held business to my children, instead of using the $10 million market value, I would make sure it's in an entity that has a non-voting interest and also has lack of marketability. And I could take those two factors into account and value the non-voting interest in my closely held business at $8 million. So if I want to make a gift of it of $8 million, I basically have made a gift economically of $10 million, but because of these valuation discounts that are legitimate valuation discounts. In the real world, if you have a non-voting interest in a company, it is not worth as much as a voting interest. And in the real world, it takes time to sell a closely held business, or it takes time to sell your real estate. It's not like a marketable security where there's no discounts and you can sell it instantaneously. So the first factor is to make sure that the ownership of your closely held business is essentially in a situation where it's a non-voting interest that also could have lack of marketability, so you can take valuation discounts. Now, here's the other thing, is your closely held business, which we now have valued at $8 million, okay? You gift that outright to your children. And there's a gift tax exemption of $10 million, so you don't have to pay any gift taxes on that $8 million taxable gift. Now, the children own that asset. If that asset, which is really worth $10 million, doubles in value to $20 million, and the non-voting interest, say, would be worth $16 million, that isn't owned by you anymore. It is owned by your children, or a trust for the benefit, an irrevocable trust for the benefit of your children. So they own it. So any appreciation in value from that 10 million market value to, say, 20 million, or the discounted value from 18 million to 16 million, is not owned by you. So essentially, by making that gift, we have frozen the amount you have exposed to gift taxes and estate taxes at that current value. So since the trust, the irrevocable trust, or your children own it outright, they have all the economic benefit of the increases in value without any estate tax exposure because it's owned by somebody else. And we call that a freeze. Or you don't have to gift it. Suppose you fully utilized your gift tax exemption. In that situation, you can't make another taxable gift because you fully utilize your gift tax exemption. So what you do is you sell it to the children for a promissory note. So all you have is a promissory note, say, for our $8 million. The children now own the business by giving you an $8 million promissory note. So if the business doubles in value from 10 to 20 million, that's also out of your estate. So another way of achieving a freeze is to sell the asset to your children. Now, interestingly enough, the Internal Revenue Service doesn't look at market rates for that promissory note. They have what's called the applicable federal rate, which is based on one-year T-bill rates. So let's go back to a simple example. I have a $1 million asset that is producing $60,000 a year of operating income, and it's worth $1 million. I sell that business, to that $1 million business, to my children for a $1 million promissory note at the IRS interest rate they're required to use, which is 4%, It's called the applicable federal rate. The applicable federal rate is based on 1-year Treasury bill rates, so it's always below market rates. But the key is, my business, my $1 million business, is making $60,000 a year, but I sell it to the trust for a $1 million promissory note at 4% or $40,000. So the children now have an income-producing asset that makes $60,000. They pay $40,000 in interest expense, so they get the financial leverage benefit of keeping the spread. In other words, you borrow money at a low interest rate and you reinvest the proceeds. So that is another factor that we use to shift appreciation and value. Okay, it's called financial leverage. So we have discounts, we have basically what we call the financial leverage, and we have the freeze. Those are 3 of the 4 factors. The fourth factor is an anomaly for federal transfer tax and income tax purposes, in that essentially when you sell this asset, let's suppose we sell the $1 million asset to a trust that's called a grantor trust. We sell it to a trust that's called a grantor trust. And the anomaly is a fiction is created for federal income tax purposes only. Even though the trust is a separate taxpayer for gift and estate tax purposes, for income tax purposes, you, as the creator of this unique trust called a grantor trust, it's disregarded for income tax purposes. In other words, the grantor is deemed to own all the trust assets. So they disregard the note, and essentially that means that the trust earns $60,000, but the grantor has to report the $60,000 of income on their individual income tax return. So in that situation, if you're in the 40% income tax bracket, and 40% times 60,000, and always do examples that have nice even numbers so you can do the math in your head. That means the grantor has to pay $24,000, and it comes out of the grantor's retained assets. So that burns or depletes the grantor's retained assets. And so what you have to take into account is the fourth factor, that you are paying the income taxes on the grantor trust income, okay? So what this means is you not only have shifted the extra earning capacity to the trust and all the appreciation and value to the trust, and you took this discount, which allows you to have a lower transfer, but you also have to take into account the depletion of your assets by having to pay the income taxes on the grantor trust's taxable income. Now, there's another factor that you have to take into account, and that is the individual is also going to deplete their existing assets by their personal living expenses, in addition to all the income taxes they pay. All right. So here, let's take a simple situation. An individual has $20 million of investment assets that are producing a nice, say, 5 or 6% rate of return. They also have income from Social Security in their retirement plan. And they have more, and they basically have a sufficient amount, so they want to take advantage of making a taxable gift. So let's suppose out of that 20 million, they take 10 million and gift it to a grantor trust. So that means all the income in the grantor trust, all the appreciation and value, are all in the trust out of your estate. The only thing is, they have the income from their retained assets, and they have to pay the income taxes on the grantor trust income, and they also have their personal consumption. So you do a financial analysis, and you basically see if they retain 20 million, the income on the 20 million would not be sufficient to pay all their income taxes and all their personal living expenses. So let's suppose that every year they would have to the income was a shortfall of $300,000. So they would have to invade principal of $300,000. So that means at the end of the first year, if they invaded the 20 million and invaded 300,000 of principal to pay for their living expenses and income taxes, their principal would be depleted to 19.7 million. Well, if you basically carry this out, 20 years is going to, 20 million will provide them with enough principal to provide them with everything they need for their living expenses and their income taxes for the rest of their life. But if you gift $10 million to a grantor trust as a taxable gift, you don't have the income from the 10 million in the trust, and your retained principal is 10 million. And when you start taking into account the fact that you're getting less income and you still have your same living expenses and you still have to pay the same income taxes on your retained assets plus the grantor trust assets, you're going to not be depleting 20 million of principal, you're going to be depleting 10 million of principal. And if you use the assumptions, and let's suppose you have an individual age 70 that does this, and you run the numbers, you can show that the two factors that will deplete your remaining assets, your living expenses and paying the income taxes on the trust income, will totally deplete that 10 million at age 86. And you say to the client, it's the perfect estate plan. If you die at age 86, there's no estate taxes on that 10 million you retain. And the client says, little bit of problem. I'm still going to be alive. So what you do is you say, well, wait a minute. You got to retain. You can't gift enough away. What you have to do is you can't gift 10 million and keep 10. Maybe what you should do is gift 8 million and keep 12. So you run a financial projection and you see at age 86, they still have enough principal, but you see, wait a minute, at age 92, we've depleted all your assets. And now you tell the client, perfect estate plan, just die at age 92. And the client says, but wait a minute, I'm still going to be alive. I work out all the time. You know, I'm a vegan. I don't eat any of that stuff. So essentially, you say to the client, well, let's do another financial projection. And instead of gifting 8 and keeping 12, let's gift 4 million and keep 16 million. And the client says, but I'm keeping 16 million. But you'd run the financial projections and you will see in that situation that there is enough money in there that they will provide you with principal to age 101. And the client says, now, so basically the fact of my personal consumption, which increases each year, and that all of the buildup in that grantor trust, even though it's got 4 million, it builds up because it doesn't pay any income taxes, so that it might be 8 million by age 100. But the whole point is that you have to run these financial projections to show the financial impact of all these factors. Now, an outright gift is really the simplest one, but you see that gifting 4 and keeping 16 means that at age 101, you run the financial projection, and at age 101, you're left with only $5,000. But at least they're comfortable. So all you have to do is go take your Excel spreadsheet and manually do all these calculations. Now, there's a problem. Number one, to do all these calculations manually will take you hours if you're conversant in Excel and all the formulas. Now, remember that most lawyers are not really accountants who can do this off the top of their head. They want to set, so the lawyers will say, well, is there a program that will do it all for me? In other words, when you want to basically show the client different financial situations because the financial impact on their remaining assets can be significant or insignificant. And so what you want to show the client is this in a simple spreadsheet. Is there a commercial program out there that allows you to do all that? And most of the commercial programs only look at the buildup in the trust and the estate taxes saved. None of the commercial programs take into account the impact on your retained assets. So what we have, interestingly enough, is there was a program called EstateView. Was like, because they heard one of my lectures of how you got to take into account what we call the impact on your retained assets, and basically allows you to put in these factors, and then you click on compute, and within 2 minutes you'll have a spreadsheet that shows you the financial impact of everything. So it allows you to communicate how all these factors work to build up assets in your irrevocable trust that's not exposed to estate tax, and also show you the impact on your retained assets, so you have to know enough so you get to figure out how much of your assets you should retain to pay for everything over the rest of your life, and not just to age. Remember, your life expectancy, if you use the IRS's actuarial tables, the IRS actuarial tables say someone age 70 has a life expectancy of 15 years. That's 85. Well, the point is there's a 50% probability you'll still be alive at age 85. So you got to run your projections out to an arbitrary number. We like to run them out to age 95 or 100. But to do that manually takes a lot of time. So basically in development stage, there's something called EstateView, which I have been intimately involved in. I'm not doing the programming, but I'm telling, this is what I want. And none of the commercial programs show this. So could you develop a program? And Alan Gassman and his team have spent all the money developing EstateView, which is still in its development stages. So here's the key. Within the client gives you all his assumptions. You put all that in, and whatever you allocate to the estate plan and whatever you keep will run the financial projections. And what happens is, if the initial assumptions show you're going to be depleted at age 86, you say, I'm not going to put as much in the estate plan, I'm going to keep more. So what it allows you to do is not only show the client the financial impact of the estate plan, but it shows the client how you can change the assumptions, and the client can then be designed and help you design the financial aspect of your estate plan. So number one, by having numerical examples in these spreadsheets, which can be done instantaneously once you put all the data in, it allows you to communicate to the client using the spreadsheets, which is an understandable manner without getting into technical terms, the impact of the estate plan. And when you see it's too much that's being depleted, You just gift less and retain more, so you can reach, and so the client gets involved in making the financial decisions, not just the legal decisions. So that is what EstateView allows you to do in a very efficient manner. And, so you can spend an hour with the client financially designing the estate plan, whatever technique you use, whether it be an outright gift, whether it be a grat. Well, see, I'm using a grat, that's a technical term, or a clat, or an installment sale to a grantor trust. Whatever these technical techniques are, you have a spreadsheet that illustrates them without having to try to explain it using technical terms. And then the second important aspect is it allows the client to financially make the financial decisions as to how much to commit to the plan and how much to keep. So those are two important factors that can be done with the client in an initial 1 to 2 hour meeting. Now, the third thing the client is going to ask is, can you give me a PowerPoint presentation illustrating this, or can you give me a document that explains it all? And for you so you've done the financial illustrations, and then if you manually have to prepare a slide presentation or manually have to write up the explanation in just a Word document, that's going to take hours. So what EstateView allows you to do, and this is the third aspect, it takes all the data from your spreadsheets and you click on import it into my PowerPoint presentation or import it into my Word document, so you'll automatically have a slide presentation that does that shows you all the steps, or a Word document that just describes it in excruciating detail. And this can all be done in a very time-efficient manner. And this was developed over a long period of time. It all came from telling my students, we have to communicate all of this in an understandable manner, and you have to get the client involved in the design of the structure without using all these technical terms like reverse Q-tip or GST exemption and all that other stuff. So it's basically designed to help you efficiently explain everything to the client in an understandable manner and get the client to participate in designing the structure so that the client can make the financial decisions as to what best suits the client's personal financial objectives. And that is EstateView. Thank you very much, and I appreciate the developers of EstateView for taking all the stuff that I've been preaching to my students over the years and making it available to the profession without having to listen to my class or lectures. Thank you very much. I don't get into those details, because that's too much.
Okay.
This was designed to give somebody a fluffy overview.
Right.
That's why before I even got into it, I laid out all the factors.
Right. Yeah.
All right. Did you understand it?
Perfect.
There is a technique that estate planners use called a self-counseling installment note. There's another technique called a private annuity. Both techniques are used by estate planners. And a private annuity is nothing more than you have a family trust that's a related party, and you give them, say, $1 million, and they promise to pay you an annuity of $100,000 a year for the rest of your life. And based on your life expectancy, if you want $100,000 a year based on your life expectancy, a commercial insurance company would say it'll cost you $1 million. Okay, but instead of buying that annuity from a commercial insurance company, you buy that annuity from a family trust. Using, now the annuity is payable for the rest of your life. So if you buy a commercial annuity from an insurance company for $1 million that pays you $100,000 a year for the rest of your life, the advantage is if you live longer in your life expectancy, you're going to get more than $100,000 a year for your life expectancy. You're going to get more, which means you're going to get more than $1 million. If you die early, let's suppose after 2 years, after getting two $100,000 payments, you die, you're no longer entitled to any payment, and the insurance company keeps the $800,000 that they didn't have to pay out. So what you do is a private annuity you purchase the annuity from your family trust. And so the estate planners do private annuities for not healthy people, but unhealthy people. For example, suppose you have a client who is 60 years old, weighs 300 pounds, so he's tremendously overweight, drinks a 6-pack of beer every day, and smokes a pack of cigarettes every day. Do you think that person who's going to live out a full life expectancy? Absolutely not. So the estate planners use private annuities for people they expect to die rather quickly. So the IRS is aware of this, so they basically have a test that says if you can show that death is imminent, we're going to disregard the mortality tables that have you living to your full life expectancy, and basically say that if you bought if you bought an annuity that pays $100,000 a year, and from your family trust, and you die within the year and only get $100,000 payment, we're going to treat you as having made a $900,000 taxable gift. So the IRS has this test that says if you can show medically that there's more than a 50% probability that you will survive beyond 1 year, will allow you to use the mortality tables. But if you show that you have a terminal illness, and a terminal illness is defined as there's a less than a 50% probability you'll survive 1 year, we're going to disregard the annuity and the mortality tables and just treating you as made a gift of the difference between what you gave to the trust and the annuity that you received. And that applies to annuities. And so what happens is the lawyers go, let's get a doctor's letter. Let's pay your doctor an exorbitant fee. Let's get your doctor to evaluate your health records and issue an opinion that says even though you're in lousy health, there's a more than a 50% probability you'll survive more than 12 months. Okay? And so that's what all the lawyers rely on when they do these private annuities. Okay? But that test, that 1 year death is imminent test, only applies to annuities. Now, let's look at self-canceling installment notes. A self-canceling installment notes is we agree to pay you a principal and interest on the note for the note term, but if you die during the note term, all future payments are canceled. So let's suppose you sell an asset to a family trust for a self-canceling installment note that says that we're going to pay you $100,000 a year for the next 10 years, okay, plus interest on the outstanding principal. But if you die, so if you live to the end of the 10-year term, you're going to get all your principal back. But if you unexpectedly die prematurely, like if you, after 1 year you die, all future payments are canceled. So what the estate planners do is say, oh, I can use that death is imminent test that are used for annuities. And if I get the doctor's letter, I'm in like Flint, even though I die prematurely. The problem is a self-canceling installment note is not an annuity. That 1 year death is imminent test only applies to annuities. A self-canceling installment note is not an annuity, it's a debt obligation, it's a promissory note. And therefore, that 1 year death is imminent rule that estate planners naively rely on basically doesn't apply to debt obligations. And in the income tax area, you can see the income tax cases where the IRS and the courts have disregarded the note term if you can show, based on all the facts and circumstances, that not all those note payments will be made. So if you issue $1 million note that's a self-canceling installment note, and you're in poor health, and even though the doctor says your life expectancy is 5 years, so you meet that 1 year test that applies for annuities, but this is a debt obligation, so it's a facts and circumstances test, and all the income tax cases that disregarded promissory notes use those facts and circumstances tests. So if you have a doctor's letter that says you'll survive more than 1 year, but it says you're not going to live more than 5 years, the IRS and the courts will disregard that note and treat you as making a gift. So essentially, instead of using the mortality tables that are used for annuities, use the income tax mortality tables, which have different life expectancies. Okay. And the discount rate is not the discount rate you use for annuities, which is called the Section 7520 rate. It is the discount rate used for debt obligations, which is always different, which is always less than the discount rate used for annuities. So essentially, if you're doing a skin, you can't use the discount rate and mortality tables used for annuities. You have to use the discount rate and mortality tables used for debt obligations. And this is not very well known. Because the commercial programs, for some reason, assume that your life expectancy is the maximum term, they don't allow you to do a self-canceling installment note for greater than your life expectancy. But someone age 70 has a 15-year life expectancy, so they don't allow you to do they don't allow you to go beyond life expectancy, but that's for annuities. A skin is a debt obligation, so it can be for any term. So if you wanted to do a skin for somebody age 70 more than 15 years, the commercial programs don't allow you to go beyond 15 years, but because it's a debt obligation, you can go beyond that and say 20 years or whatever for the note term. But it's not well understood in the estate planning profession, and there's a few articles on it that actually go into it that are out there, but nobody bothers to read them for half the time.
But EstateView runs the numbers.
EstateView runs the numbers that allows you to go beyond life expectancy for the term of your skin.
So, Jonathan, how comfortable can we be with a 2-year grat that pays out about 90% of the payment at the end of year 1 and another 10% at the end of year 2?
Well, Alan, of course, there are no guarantees in the law, especially in the tax law, but there are a couple of things to think about. The regulations put a 20% upside increase in an annuity, but no downside. In fact, there is an example in the regulations where the reduction was about 50% in 1 year. And they just gave it as an example, indicating you can do whatever you want. But perhaps more important, Alan, as you know, I've developed language to completely protect the client by using word formulas. For example, if you're worried, can I really do a short-term GRAT, 2 years or 366 days, which one case at least impliedly approved, what you can do is to say that my GRAT will last the longer of 2 years or whatever the minimum term has to be. So the annuity interest is a qualified interest within the meaning of section 2702. You can do the same thing with the amount of reduction. The reduction shall be 90% in the first year, or the maximum percentage decrease permitted under the regulations to still have a qualified interest under section 2702. So again, there's a high probability that you can do it, but if you're nervous at all, please use those word formulas which are going to protect you.
Hi, this is Alan Gassman, and you are here today for the Asset Protection Tune-Up. It's the same old stuff I've done before with a different name and a different cover. Remember, Noah built the ark before it started raining. To say, oh, I'll just wait till the last minute. If something bad happens, I'll call this guy I saw on YouTube, and he'll be able to protect my assets, and that'll be no problem. Or, oh, I have $500,000 worth of insurance. That should settle almost anything. Well, those are absolutely wrong assumptions. Any debtor will be much better off doing the planning earlier rather than later. And if you're not sure about the advice you're getting, get a second opinion, get a third opinion, get a fourth opinion. But do so under the attorney-client privilege to the extent that you can. An asset protection trust. This is a trust arrangement where you appoint a trustee who lives in an asset protection jurisdiction. And that trustee, or a trust company with offices there, that trustee holds assets for you under a written trust agreement where the law of the situs, that's where the person, the trustee resides, is going to be controlling. And the laws of certain jurisdictions say that creditors can't reach into the trust unless certain things happen. What is an asset protection trust? Asset protection trust is a special type of trust where the person who puts the assets into the trust may be a beneficiary of the trust, but creditors can hopefully not reach into that trust. The Asset Protection Trust is the most popular and profitable product, and I'll use the word product there, that creditor protection professionals are generally using to protect people's assets. And I use asset protection trusts, but usually not, and almost never, for somebody who has an imminent creditor problem. The biggest liability risk is not malpractice. It's not even divorce, although you should be nice to your spouse today for a change. It is automobile liability. Don't let anyone drive your car but you, and don't drive your car under the influence of alcohol, marijuana, anger, while you're texting, which is even worse now. We have time and time again, week after week, every year, people who come to us who may lose all their assets because of a terrible automobile accident.
We are very blessed to live in the great state of Florida, which probably has the best creditor protection of any jurisdiction in the world. You have protected homestead, up to 160 acres if you're out in the county, up to half an acre within the city limits. You have your IRAs, you have your 401ks, you have your permanent life insurance policies, you have annuity contracts, you probably have wage accounts, wages that come in and are invested in other creditor protected assets. If you're married, you have tenancy by the entireties. If you're saving for your children's college or maybe college of someone else, you have 529 plans. Those are all protected and exempt assets. And if you have these assets properly situated and somebody finds a reason to sue you for millions of dollars, they can't take these assets. And also, if it's a business debt, you can file a Chapter 7 bankruptcy and keep all these assets and no longer owe the judgment. So welcome to Florida. It's not a bad place to be.
Now, when I started practicing law in 1984, almost every doctor had his or her own practice or shared a practice, and they had a CPA who cared about them. They had a lawyer who cared about them. They had an actuary who did their pension plan. They had financial advisors, because there wasn't anything such thing as Vanguard back then. You had a financial advisor, and we all got together and communicated with the client. And we all cared about the client. And if one of us got out of line, the others would rat them out. And most doctors don't have a team of advisors anymore. Now, it's less expensive now to have a team of advisors than it was. And there are CPAs who care. There are lawyers who care. And then there's a lot of lawyers and CPAs who haven't been trained how to care. We used to get mentored when we got hired in the 1980s, back before I invented the internet. We used to talk to clients because we didn't have computers to look at and watches to look at and phones to look at. We actually had to talk to people, and then we cared about them. So the cost of having a lawyer and a CPA who actually care about you is very low compared to the possible result if you don't have that. Being a doctor is not a cakewalk. It has some difficulties. Take care of your health, doctors, because a lot of you don't. And then you have health problems and you don't even get an annual blood test. Now, because I do creditor protection work, I do warn clients that eventually, if you're a good physician and you do a lot of volume and you stick out your neck to help a lot of people, you will be sued. And no, they don't always settle for your limits of liability. Look at this one. The doctor had a $1 million policy. The jury came in at a mere $116 million. So not such a good day for the doctor. Now, the doctors then sued the lawyers for not defending them correctly. And what they sued the lawyers for was that before the trial, the plaintiff offered to settle for $1 million. And if the doctors had written a letter to the carrier saying, I've been offered to settle for $1 million, you're my carrier, you have a duty to settle this. If you choose not to settle it, this is your problem, not mine, because of what we have in Florida called the bad faith rule, and therefore, please settle this. Then, the verdict would have been paid for by the insurance company. But instead, the lawyers apparently did not warn the doctors about this or tell them to write the bad faith letter, so the lawyer's malpractice policy maybe ended up paying part of that $116 million. But we want you to approach your creditor protection responsibly. The other thing that I tell the first-year surgeons that a lot of doctors have told me is one of the best things they've ever heard is when you meet with a patient, and this applies to lawyers and accountants too, when you meet with a client, I want you to spend just 30 seconds while you're sitting there and think, what's the worst possible scenario for this patient that can get me sued? sometimes in the planning world, people ask, how do you come up with a good plan? Well, another great Tom Peters quote, ready, fire, aim. Just try some things out, run the numbers on them, get a 14-year-old to help you see how Excel works, and always, if you can, under-promise and over-deliver. So when you get a client whose 75% of their net worth is brand new because their beach property is now worth more than everything else they have, their cryptocurrency is now worth more than everything else they have, and you explain, you know what, if you sell today, you can maintain the XYZ standard of living for life. If you don't and it crashes, then you'll have to work an extra 10 years. That's okay. I'm confident it will not crash. Favorite estate plans always have plenty of cash on hand to deal with the unexpected. And I don't know, when you did your New Year's resolutions, did you budget for problems? I used to really worry about every single problem that was unexpected and cost money for our office until I set up a $100,000 a year budget for problems. And I'm just so happy if we don't hit the whole budget. One of my favorite estate plans, fully insure. You can put that life insurance in an irrevocable life insurance trust if you want to make sure that it's protected from creditors, if you live in a state that doesn't protect life insurance, and if you want to make sure that you do not pay estate tax on the life insurance. If the client owns the policy or has what they call incidents of ownership over the policy, then it will be in the client's name for estate tax purposes.